It looks to me that there's a run on gold, physical gold. Whenever there's a realignment, monetary realignment, it means that the old system is dying. So the current system, or the old system, is the fiat debt-based dollar.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials while supplies last. Pre-1965 mixed junk silver is just $1.99 over spot per ounce, and pre-65 half dollars are just $2.25 over spot per ounce. Backdated 1-ounce gold South African Krugerrand are just $49 over spot per ounce. And 10-ounce silver Nordic Mint bars are just $2.10 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Mario Innecco from the very popular Innecco64 YouTube channel. Mario, thank you so much for joining us today.
Oh, you're welcome, Elijah, and thanks for having me on.
Well, it's great to have you on. I know last time we had you on, you were with Andy Scheckman there on our weekly market update. So that was fantastic to have the panel with you and Andy. My father Dunnigan was hosting that. We really wanted to today talk about the what is happening in London. Now, this has been happening really since the beginning of the year. It was reported that in January, millions of ounces of gold was flowing from London to the US. And also, we've also seen huge outflows from COMEX. So people are talking about, is this tariffs? Is this, taking advantage of price arbitrage? Some people have even speculated maybe the US is, trying to get the gold back into Fort Knox if it's missing. But your take on what's going on?
Yeah, I guess it's been going on since I think mid-November or sometime in December. And we only really learned about the problem on the LBMA or in the London bullion market back in January 29th, when an FT report or article came out and said that the spot delivery was had been extended to from up to 4 to 8 weeks. So instead of T plus like 2 or 3 days, 4 to 8 weeks. So there's definitely something wrong there. And yes, I reported on that right when that came out. I thought it was really significant. And I'm not trying to brag, but I said at the time that it was the most important development in the gold market, maybe since Gordon Brown pre-announced the sale of half the UK's gold back in 1999. Yeah, and from what I know, the delivery on the LBMA and the London vaults is still delayed, and I think Elijah, it just shows that there's a de facto default right now in the London bullion market, and that's very serious. And I'm not saying there isn't any gold there. I think it's just the way they rehypothecate, or they fractional reserve gold, or they trade paper gold, is basically kind of been exposed. Maybe not because people have been talking about it like I have and many others, but because for some reason someone in the US, we can speculate who that is, someone wants the physical, and they don't want just the physical in the vaults, or through the EFP, which is like a mechanism to trade between COMEX and the LBMA. And EFP stands for exchange for physical. But when I worked in the futures market, I can tell you that when my colleagues did EFPs, I wasn't too involved in that. It didn't mean physical. It just meant another paper scheme. But now the people, whoever's taking the gold in the US, they want it out of the LBMA vaults. They want it into COMEX and out of the COMEX vault, because a lot of deliveries on COMEX prior to now were just done through the vaults. You just change, it's going to go from account A to account B, but the gold itself had always stayed there. So it looks to me that there's a run on gold, physical gold, and I guess we can speculate why. It could be, the Treasury needs to do an audit of its gold, and a lot of it left, so they need to bring it back. Or investors are just concerned about all the uncertainty, geopolitical, trade wars, and whatever, and the possibility of even a major war. I don't like talking about the Third World War, but President Trump even mentioned it when he was having a chat with Zelensky the other day. He said, you're going to, trigger World War III. And from what I've learned and studied in the past about gold, and Alan Greenspan once said that during war or major conflicts, nobody accepts paper. Countries need gold to pay for their war effort.
Now, when it comes to a run on gold, what you're talking about, did you want to expand on it seems to be such an interesting situation we're seeing right now. And just about 2 weeks ago, for about a month or 2 weeks here, we were seeing on the retail side, premiums just collapsing, the buyback premiums, the retail premiums. We were seeing a strange situation where we were actually able to, swap clients out of 1 ounce bullion product into, the semi-numismatic coins. And it was really anomalies occurring, but the overall story seemed to be that premiums were way down. The retail public is selling, not buying. But at the same time, huge outflows from London. So like the big money buying, getting ahead of the game. And now we're starting to see a shift on the retail side where premiums are creeping up again. So I don't know if this is if we saw the calm before the storm, or if this is a signal in your mind that, the big money has placed their bets and now it's about to be the retail public. Your perspective on these different dynamics that we've seen over the last month.
Yeah, I mean, if we go back the last 3 years, the big money, i.e. the major central banks and governments of the world, like especially the BRICS and BRICS-aligned countries, they've been buying the most net gold since the beginning of the Bretton Woods agreement in 1944, 2022, 2023, 2024, record amounts. And I think personally, there is a probability that U.S. Treasury is coming, new Treasury, new administration, and they know about this. We've seen Marco Rubio, prior to him becoming Secretary of State, say that the BRICS are not going to use the dollar. The Treasury Secretary, in an interview prior to even the election, Scott Bessent, he said that he expects Bretton Woods-like realignment. What does that mean? Well, it means that we're going to have a new monetary conference amongst the major powers of the world, just like we had towards the end of World War II. And whenever there's a realignment, monetary realignment, it means that the old system is dying. So the current system, or the old system, is the fiat debt-based dollar. And and now, so it could be I think it's a good chance that it is the Treasury bringing back its physical gold, but it could also be very heavy hitters out there. One case in point being Warren Buffett, whose company Berkshire Hathaway has $334 billion in cash, and I saw that in his recent recent letter to his shareholders at the end of the year. For 2024, it came out about a week ago. He said that paper money is always, you can't trust paper money nor government bonds. That's what he said. And I think that was very telling, despite the fact that he's holding a lot of the $334 billion in cash and treasury bills. And of course, he has said in the past that gold You mine it, you bring it out of the ground, and then you refine it and turn it into bars or coins, and then you put it in the vault again. Uh, I think he might have been being a little bit facetious there. His father has his father was a congressman from Nebraska, and he was a sound money advocate. So I'm sure Warren Buffett knows about gold. So yeah, as for the small investors, they're still asleep at the switch, except the people that watch our channels. I would say they've been awake for many years, but now maybe you could be right. They could be starting to look for alternatives. And why do I say that? Well, because it looks like the general stock market is starting to keel over. And I remember when I bought gold for the first time in '02, the reason I did it is because I sat down with my wife and looked at my private pension, which hadn't done well after the dot-com bubble burst, not because it was invested in the dot-com bubble stocks, but all the stock market suffered. And for some reason, we said, why don't we buy a little bit of gold to diversify? So yeah, we could be close to that. And yeah, that's how I see it.
It does seem like there's maybe the rumblings of the retail public coming back in as we can see the retail, the premiums coming up slightly here as we speak over the last week or two. But when it comes to, I guess, the big movers like the central banks you mentioned, the BRICS countries accumulating gold, we're seeing someone, taking delivery off of COMEX, taking London gold and moving it to the US. So I guess when it comes to what this could look like in the coming years, it seems like we're still very early in this bull market because the retail public hasn't jumped in yet. I mean, the signs of a bubble is when your neighbor's talking about gold, but we're definitely not seeing that sort of action right now.
Yeah, I agree. And I like to look at the Dow-Gold ratio. And if you go back about 100 years, the Dow-Gold ratio has periods where it goes up a lot. That's when there's a credit boom and the stock market soars, and then it corrects like it did in 32. And I think it went down to 2-1. It had gone up to like 25 or 20-1 in 1929. And then it took like, how long was it? Yeah, it was from 32 to 1966, so another 33, 34 years for the next credit bubble. And then the credit bubble burst again, and the Dow-Gold ratio went down to 1-1 in 1980. And then it was inflated again, the credit bubble. Stocks became more valuable. They became the place to be, in gold and hard assets not. And then by the year 2000, that ratio was like above 40. It had been around 26 in 1966. But ever since 2000, that ratio hasn't seen a new high. So in terms of gold, the stock market has been in bear market. But since 2011, we've seen a correction in that ratio from around 6 to around 2022. And now it seems to be breaking down again through 15, Elijah. And I think eventually, yes, we could be on the cusp of a new move away from paper stock assets, stocks and bonds. Not completely, but just a small amount will make a huge difference. And I could see that ratio going back down to 1, maybe even less in the next 2 to 3 years. It sounds quite, it sounds outlandish, but it's happened before. So if we go down to 1-1, let's say gold could be at 20,000 and the Dow could be at 20,000. It could be any level, but it means that you can buy a lot more. You can buy a lot more stocks with gold. And if it goes to half, it means that you're only going to need half an ounce of gold to buy a Dow. It could be higher. It could be, gold 40,000, Dow 40,000. It depends how much the Fed and Congress decide to inflate the system again, if they can. But if they can't inflate or hyperinflate, we could see a 1929, 1930 style crash. But even then, I'd be holding on to my gold because there's no counterparty risk. And when there is a crash in a depression-like environment, you want to have you don't want to have counterparty risk because a lot of banks, corporations, and people go broke and can't pay you back.
Now, when it comes to the stock market, you mentioned the Dow-Gold ratio. We are seeming to see a wobbling in the stock market, possibly a topping out at the moment. There is concern, obviously about tariffs on Canada, Mexico, and China right now. Your perspective on where the stock market is right now?
Yeah, I mean, there are a lot of people blaming these tariffs on the stock market move. People are saying it's going to slow everything down around the world. Maybe so, but I think they're more of a symptom of this, how can I say, this cycle of the move from paper assets to hard assets, which is represented by the Dow-Gold ratio. So whatever Trump does or other countries do, I think this doesn't really matter. Whatever they do, and they might reverse the tariffs or whatever. I think it's this move is unstoppable because things go in cycles, and the stock market. The other thing I would say, look at Warren Buffett. He's 300. He hates cash, but he's got 334 billion of it. That must be for some reason, and I guess he doesn't get things always right. But for one of the arguably the most successful investors of the last 60 years to have that much cash, is that he's worried about something. And he looks at the market capitalization of the stock market to GDP, and I think it's at over 200%. And that's always like a massive top. So I don't see things going well for the stock market, especially relative to gold and commodities and silver.
It seems to be, a lot of red alerts in the economy right now, in the stock market. What are some of the other signals besides just tariffs that you're seeing that something big could be happening soon?
Yeah, I guess the yield curve, like the 3-month to 10-year yield spread, that's starting to steepen again. We saw the Atlanta Fed. They published this GDP Now data. They revised it from just above 2% to minus 2.8. So these Federal Reserve regional banks, they keep track of what's going on in their district economically, and for them to revise it down that much is showing some signs of trouble. And also maybe treasury yields coming down, like the 10-year yield got up to almost 4.5% recently, and now I think it's just below 4.2. That's a signal that a slowdown could be coming. And I don't think the Trump administration cares about the fact that that's happening, because if we are going to have a recession, if we are going to have a correction or some kind of crash in the stock market, it might as well be early in the administration.
It does seem like there, as you mentioned, a lot of different things coming together here. So it should be definitely interesting to continue to track this with you. If our viewers are interested in learning more, they can go to youtube.com/Innecco64. We'll put the link in the description of this video so they can subscribe to your channel there, as well as ours, and hit the bell icons so you'll be notified when new interviews from us come out, and also new videos from you. Any last thoughts before we let you go? What should viewers be paying attention to in your mind right now?
Attention. Well, yeah, keep an eye on the Dow-Gold ratio. I think that's keeling over. What else? Keep an eye on the 10-year yield, which is something that most people don't look at. But if that keeps dropping, which means investors are buying treasuries, that could be a bad sign for, it means that they're running to safety, even though I think gold and silver are where safety is, but you can't expect mainstream investors to do so. So yeah, keep an eye on those two indicators, I would say.
And that does bring up an interesting point, how small comparatively the gold market is and the silver market, right? Compared to the other safe haven out there, U.S. Treasuries. If just a little bit of funds come out from the U.S. Treasury market into precious metals, it could be really explosive.
Yeah, and I saw someone note the other day that the market cap of Microsoft, maybe that's come down now, but let's say it was $3 trillion, and all the gold held by central banks was also $3 trillion. So you have the world central banks who manage currencies throughout for the planet. Their gold holdings is only worth what Microsoft is worth, which doesn't make any sense at all. It just goes to show how overvalued the stock market is.
Well, Mario, it's always a pleasure to have you on. Again, we'll put a link in the description to your YouTube channel. Thank you so much, and God bless.
Thank you, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials while supplies last. Pre-1965 mixed junk silver is just $1.99 over spot per ounce, and pre-65 half dollars are just $2.25 over spot per ounce. Backdated 1-ounce gold South African Krugerrand are just $49 over spot per ounce. And 10-ounce silver Nordic Mint bars are just $2.10 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.